Welcome back to Mastering MHA MBA. In this video, we tackle the harder process costing problem. When partially complete units sit in inventory at both the start and end of the period, you will leave knowing how to apply both the weighted average and FIFO methods and when each one matters. In part 1, we covered the foundations, equivalent units, the 5 steps, and a clean case where nothing is left in flight at month end. Real production lines are messier. Beginning inventory carries over from last period, ending inventory rolls into the next. Now you face a choice of valuation method. By the end of this video, you will be able to apply the weighted average and FIFO methods to a process costing problem with both beginning and ending work in process, compare the results, and explain why managers choose one method over the other. Pacific Electronics enters March with 225 partially assembled units left over from February. Those units are 100% complete on materials and 60% complete on conversion. The plant starts another 275 units. By month end, 400 are finished and 100 are still on the line. The total cost pool is $62,280. The question is how to split that pool. Two methods dominate practice. Weighted average lumps together every dollar that ever hit the work in process account, regardless of period, and divides by total equivalent units done to date. FIFO keeps the layers separate. Same data, different assumptions, different numbers. Both methods follow the 5 steps from part 1. The weighted average method treats every unit identically. It does not care if a unit's cost was incurred last month or this month. It pools all costs, pools all equivalent units of work done to date, and computes one blended cost per equivalent unit. Simple to apply, smooths out cost swings. Step 1. 225 units in beginning inventory plus 275 started equals 500 to account for. 400 went out the door, 100 are in ending work in process. Step 2 for weighted average is straightforward. Equivalent units of work done to date equals units completed plus equivalent units in ending inventory. Materials, 400 plus 100 equals 500. Conversion 400 plus 50 because the 100 ending units are 50% complete on conversion, so 450. Step 3. Beginning work in process carried $26,100 of cost. March added $36,180. Total to account for $62,280. Step 4. Add up all materials cost from beginning plus current period, $37,800. Divide by 500 equivalent units. Materials cost per equivalent unit, $75.60. Same logic for conversion. 24,480 divided by 450 equals $54.40. Step 5. The 400 completed units take 400 equivalent units of materials at $75.60 plus 400 equivalent units of conversion at $54.40. That is $52,000 even. The 100 in ending work in process take 100 equivalent units of materials at $75.60 plus 50 equivalent units of conversion at $54.40. That is $10,280. The two add to $62,280. Closes the system. FIFO refuses to mix layers. It says the units already in beginning work in process were partly built with last period's costs and last period's prices. Those costs follow them out the door first. New work, started in the current period, gets the current period's cost rate. This separation gives you sharper period-to-period cost information. Under FIFO, the 400 completed units split into two groups. The 225 from beginning inventory are completed first. That leaves 175 units that were both started and finished in March, plus the 100 still in ending work in process. 3 buckets to cost separately. The total still equals 500 units to account for and 500 accounted for. Now the equivalent units math gets sharper. For the 225 from beginning inventory, only the work done in March counts. Materials were already 100% done, so 0 equivalent units of materials this period. Conversion was 60% done, so 40% of 225 equals 90 equivalent units of conversion done in March. The 175 started and completed are 100% both. The 100 in ending WIP are 100% materials and 50% conversion. Add up the columns. 275 equivalent units of materials, 315 of conversion. These are work done in March only. Total costs to account for is the same 62,280 as before. But step 4 changes. FIFO divides only current period costs by current period equivalent units. Materials, 19,800 divided by 275 equals $72 per equivalent unit. Conversion, 16,380 divided by 315 equals $52. Notice these are lower than weighted average. Inputs got cheaper this month. Bucket 1. Beginning inventory keeps its original 26,100. Add 90 equivalent units of conversion at $52 to finish it. 4,680 more. Total cost of those 225 units, 30,780. Bucket 2. The 175 started and completed take 175 times 72 of materials plus 175 times 52 of conversion. That is 21,700. Total transferred out, 52,480. Bucket 3. Ending work in process. 100 units at 72 materials plus 50 units at 52 conversion equals 9,800. The 3 add to 62,280. Here is what the two methods produced. Weighted average sent 52,000 out and left 10,280 in inventory. FIFO sent 52,480 out and left 9,800 in inventory. The total is the same. The split is different by $480. That is a 4.9% gap on ending inventory. Spread across thousands of products, this becomes real money. The split happens because input prices changed. Last period materials cost $80 per equivalent unit. This period 72. FIFO assumes the higher cost old units leave the building first, pushing more cost into cost of goods sold and leaving lower cost current period units in inventory. Weighted average blends old and new, splitting the difference. When prices are flat, both methods give nearly identical results. In a falling cost environment like Pacific Electronics, FIFO produces a higher cost of goods sold. Higher COGS means lower operating income, which means lower taxes paid. That is real cash to the company. In a rising cost environment, weighted average is the tax winner. Either way, the inventory choice is a real after-tax cash decision, not just bookkeeping. Here is the catch. If a manager's bonus is tied to operating income, the manager wants the method that maximizes income, even if it pays more tax. Boards and CFOs design compensation plans that reward after-tax cash flow precisely to fix this conflict. Watch for it on case studies. One more lever. A FIFO switch in falling price periods can hurt operating income and ratios used in loan covenants. If a covenant breach triggers loan acceleration, a CFO may pick weighted average even at a tax cost because the company cannot afford a liquidity squeeze. The exam loves this kind of multi-objective trade-off. A footnote that matters for graduate exams. US GAAP also allows last in, first out or LIFO, which ExxonMobil famously uses for tax savings. IFRS does not allow LIFO at all. If you ever consult on a company that reports in both standards, this becomes a structural choice, not a clerical one. CMA and CPA exams almost always show this as a multi-part problem. They give you beginning and ending WIP, ask for both methods, and then a comparison. The classic trap is forgetting that FIFO uses current period equivalent units only, while weighted average uses to-date equivalent units. Mark each calculation with the period it covers. The same logic shows up in any service operation with month-end census effects. A hospital ends each month with patients still inpatient, partially through a stay. Their costs to date are real but not yet final. Service line cost reports either average across patients or trace by admission cohort. The analytic question is identical. Do you smooth or keep the layers visible? Quick recap. Weighted average pools all costs and divides by all equivalent units done to date. FIFO separates the layers and uses current period costs and current period equivalent units. The two diverge when input prices move and inventory levels are large. In Part 3, we leave process costing and tackle hybrid systems plus joint and common cost allocation. If this helped, subscribe to Mastering MHA MBA. Part 3 closes Chapter 5. Source Datar and Rajan, Managerial Accounting, Pearson.